This is your brain on risk. This is Mind Over Money, the podcast where Kevin Cook exposes the psychology of investing.
Welcome back to Mind Over Money. I'm Kevin Cook, your field guide and storyteller for the fascinating arena of behavioral economics. I'm back after a little bit of a hiatus. I broke my leg on Super Bowl Sunday.
Oh my gosh.
Wasn't actually playing, but just goofing around. And so I took some time off, worked from home, didn't make it down to Chicago very often to our studio to record my podcast. But I'm back and ready to go, and I've got a great guest for you, Tracy Reineck. And she has her own podcast here at Zacks, the Market Edge podcast. And she and I are opposites in this respect. She has, when she set out to do her podcast, she knew that the formula for success was to hit it hard, be consistent, and make sure if you're on a schedule once a week to always be there. And she did that, and she's got thousands of followers and listeners on iTunes. And so hats off to her. You should check out the Market Edge podcast. Always interesting topics. And I've been a guest on there several times, so there's some good ones there. I think I was on recently. We talked about semiconductors, right?
Yeah.
Was that on Market Edge?
You were, and I just retweeted that out because of all the Micron news and all this. I told people over Memorial Day weekend if they were bored, they should check it out. And a lot of people did.
Yeah, and I posted a chart of the semis getting ready to move higher again, and took out the semiconductor index, the Philly semi SOX, took out 1380, is trying to get to 1400. But the reason I brought Tracy on today is to talk about a topic that we're both fascinated by and is the subject of Mind Over Money, and that's the psychology of investing, especially if you're caught in that limbo between being a trader and being a longer-term investor, and how you sort that out, because you can't wear both hats at the same time and succeed. And by the way, I should remind my listeners that Tracy is also a manager of model portfolios here at Zacks. She runs the Value Investor service and the Insider Trader. So you can find some of her real, stocks where she puts her money where her mouth is in those portfolios. But what inspired me to bring Tracy on today was I get this magazine, a quarterly magazine from Charles Schwab. It's called On Investing. And their topic, the cover article, is Mind Over Matter, Overcoming the Mental Mix-Ups That May Be Costing You Money. And one of the things they have in here is a quiz. So Tracy and I took the quiz, and we're going to go over the answers if I can find where I left it.
So when you got this comes in the mail, right?
Yeah.
And when you got it, did you go, oh my gosh, did you
no,
break it open immediately and start reading? Or?
No, in fact, I almost lost it. I think I cleaned out my car and I found it. I'm like, all right, I should see what this is about, Mind Over Matter. And then I looked at it. And then this morning, I still didn't even have, I knew I wanted to do a podcast, and I still didn't even have a topic. And then I flipped it open and said, oh, wait, this is kind of cool.
Yeah.
And then I thought, and then it's like noon, and I'm supposed to do a podcast in an hour, and I'm like, how am I going to do this by myself? Wait, I'll go ask Tracy. Tracy, I know it's kind of short notice, but I'm
always up for it.
Yeah. So you flip it open to page 32, and hopefully you guys can find this online somewhere to take the quiz yourself. But we're going to have some fun going over it, just Tracy and I. So they title the article, "This is Your Brain on Money." What's my tagline for my show? Is "This is your brain on risk" is my tagline.
Yeah.
So
Schwab, they copied you.
Yeah, maybe. Schwab does some good educational stuff.
Yeah.
So they say, take our 8-question quiz to test your knowledge of the mental mix-ups that may be costing you cash. So Tracy, how about if we read a question and then we share our answer?
Okay.
And then we'll go over maybe we'll do a couple in a row, and then we'll go over
why we got it wrong.
Yeah, the answers. So let me just read their introduction, because it's interesting. It's sort of the premise of stuff that I talk about. And in fact, in my very first episode of Mind Over Money back in November of 2016, I wanted to highlight the behavioral biases that trip us up with money, investing, short-term trading. Many of them are very similar. So this is the introduction to the Schwab article. The human brain is not a rational economic actor. When faced with uncertainty, even the best investing minds may throw good money after bad, sell at the first sign of trouble, or make all manner of muddled financial decisions. These flaws in our everyday decision-making, first chronicled in the 1970s by Israeli psychologists Daniel Kahneman and Amos Tversky, gave rise to the field known as behavioral economics, which aims to mitigate the effects of these embarrassing foibles by heightening our awareness of them. So take this 8-question quiz to find out how clear-headed you are when it comes to financial decision-making. Then read to check your answers and learn more about the most common and costly pitfalls. Okay, so question number 1. You buy stock in XYZ Corp, and after several lackluster earnings reports, find it's down 25% from what you paid for it. Which is the best course of action? A, reassess the stock as though it were a prospective investment, or B, hold on to the stock until it regains lost ground. I answered A. I'm going to guess Tracy also answered A here.
I did do A, but this was one where I wanted to see on my thing, because I would reassess, and then I would also probably buy more on that sell-off, because that's a habit I like to do.
Mm-hmm.
But I could see why people would do B, because your instinct is, oh, I have to get back to break even.
Exactly. And that's what they're really going for here. When you look at the explanation that they give in the article, is so they give the next page is the answers and why they matter.
Yeah.
They refer to the behavioral bias known as anchoring, which is you get fixed on a price. And in this case, it's the price I bought it at.
Yeah.
Like, I don't lose money unless I sell.
Right.
So I need to hold on. I need it to get back to there.
Yeah.
I mean, so many people are guilty of this, and you're not hurting anybody but yourself. And it really is a mental trap where you're fixated on the price that you bought it at, thinking, well, I can't do anything. I can't sell here until it gets back to break even.
Right.
People want break even. But really, you totally free your mind when you go, well, if I didn't own any shares, what would I do here right now with this company that it's down 25%? And like you said, your first reaction was, well, if I still like the company,
right, I'd buy more.
Yeah, and it seems to be on sale.
Yeah.
I might be buying more.
Yeah.
So I think we
That's a common one,
we
though.
both passed question 1.
Yeah.
But if you're not familiar with these types of questions, I highly suggest finding this survey, or look up my very first podcast, and you'll find some quizzes there too. Because what these hypotheticals do is that they're trying to uncover your decision making.
Right.
And everybody, the behavioral scientists call it heuristics, and heuristics is the category of rules of thumb. Like, how do you make decisions on the fly? And the thing of it is whether you learned it from your parents or your grandparents or just life experience, everybody has their own heuristics, their own way of making decisions, and not just about buying stocks, but about buying a car, buying a house, choosing a spouse, buying a pair of shoes. And these little mental rules that we have are often unconscious. And if we don't uncover them, then we don't see the mistakes we're making.
Yeah.
All right, let's go on to number 2 here. A year after buying 2 particularly promising stocks, one has surged while the other has slumped. How do you rate your performance? A, you congratulate yourself on your stock picking acumen. B, you acknowledge you're 1 for 2. Tracy, what did you put?
I did say B.
Yeah. Because we know as somewhat experienced investors that sometimes you're lucky. And the other half of that is, you know that there will be losses. So you don't just jump up and down and start doing victory laps like I'm a genius.
Right.
Because you know that as soon as you do that, you're going to get walloped on the next one.
Yeah.
So
they say this is the hindsight bias.
Right.
Like, oh, I knew that other one wasn't going to do well.
Yeah.
But that is true. I encounter on Twitter and StockTwits many people with hindsight bias.
Yeah, and if even if you don't make an investment, but you find that that's the frame you put around stocks, like you see something, oh, yeah, I knew that was going to collapse 50%.
Yeah.
Or you fall into this one where a stock goes up 50%, and you say, darn, I was going to buy that. I knew I should have
Yeah.
done. It's like pointless to go through that mental exercise
Right.
because, what you could do is say, why didn't I? What was my thought process? Was I, did I have a hunch? Did I have a research process? And then after your research process, then do you have a decision-making process? Because, not all of us are multimillionaires, and so we have limited resources.
Yeah.
So we have to make decisions about where do I put my capital?
Right.
So that's the better sort of decision-making hindsight to go through is what was my process for both research and decision?
Yeah.
All right, question number 3. Your investment advisor suggests a number of new stocks to replace several long-held, albeit underperforming, investments. How should you react? A, you hold on to the old stocks because they've been a trusted part of your portfolio. B, you listen to your advisor's reasoning and consider the new stocks over the old. Tracy?
Well, I hope we both put B down because
Yes.
we are we give advice a lot on stocks. But I could see why people would do A, where they want to just hold on to the tried and the true, even if it's not working.
Yeah.
It's hard to sell, again, things that are underperforming because you still think, oh, it might come back.
Yeah.
So.
And I think the key to B is, it says you listen to your advisor. Well, listening doesn't mean that we're not saying that you automatically take action. And I don't think that's what they're implying.
No.
There. They're not saying go out and run out and do whatever, go jump off the bridge because he or she said so. They're saying just listen, absorb the new information, and then consider, what you're being told. That's the thing. That's the way to handle any investment advice is use it as an information resource.
Yeah.
And maybe it spurs new research for you. So, and definitely being open to new research is better than going, no, I'm just going to stick with this.
Yeah.
And we've seen people do that. One theme that I'll probably bring up again, but people ask me all the time, should I buy this? Or I've got X number of dollars, 5, 10,000.
Right.
What should I do? That kind of thing. And of course, the first question I say is, well, what's your time frame? Is this
that's key?
Is this 30-year money? Like you don't care and it's retirement money and you see yourself on a beach in 30 years and it can sit and grow? Or is this 5-year money?
Right.
Or is this
I want to take a vacation money.
Yeah. Yeah. Could you lose that and then still be happy if you lost your vacation? Maybe you couldn't.
It's a little risky.
Yeah. But if it's something more serious like a new house,
Right.
or college tuition,
Yeah.
coming up in 2, 3, 4 years,
Right.
you need to be really careful about that. Maybe you could gamble a portion, but don't think, oh, I'm going to put this all on these couple of stocks and double my money and my kid will get to go to a better college or I'll get to buy a better house.
Right.
Because, that's not how the stock market works. It doesn't always reward you that way. We may come back to that theme of what is your time frame. All right, question number 4 from the Charles Schwab Investor Psychology Survey. You inherit $100,000 in cash. What's your next step? A, you hold the inheritance in cash while you evaluate and reevaluate possible investments. Or B, you invest the money according to the asset allocation in your existing retirement plan. Now, I'll give you my answer first here.
Okay.
I chose B only because I'm ignoring the actual dollar amount and how it applies to my life.
Okay.
And I'm saying, but they made it, I guess they made it that 6-figure number because they figure the average investor, that would be a significant chunk of change that they could do a lot of different things with.
Yeah.
They might be able to move. They might be able to buy a vacation house. They might be able to start a business. And I thought, well, yeah, you could just treat it like, oh, this windfall, I have to protect it, and I'm just going to keep it in cash. Or you could just do the same thing you've always been doing and say, okay, I've got this extra money, which is going to sort of upgrade my portfolio, and I'm just going to keep doing the same long-term thing that I've always done. That's what they don't have here is that they don't have the word long-term, but that's kind of the mindset that I went to. Invest the money according to the asset allocation in your existing retirement plan.
Right.
So there's the long-term reference is, well, what would you do, anyway, thinking long-term? So what did you say?
Well, this scenario actually did just happen to me.
Okay.
But it wasn't $100,000, unfortunately. I didn't get that much, but I did suddenly get this cash in
lump sum,
inheritance.
okay.
Yeah. And so I did say A because I did get it in cash. And then I'm like, what do I do with this? And I put half of it into the stock market. So I did half of it into B, into the regular allocations, basically, long-term allocations. And then I was like, oh, I'll do the other half, a little bit later. And now that's still sitting there in cash. So I could see what their analysis is when they talk about how this is analysis paralysis. Because if you suddenly get the cash, you're like, oh, well, maybe I'll just wait for the market to pull back, 5 or 10%, and then I'll put it in because it's this big lump sum, right? So you want to put it in, or, oh, maybe I'll put it in a little bit every month, but then you don't get around to doing it because you're still like afraid because it's, still going up, or, oh, it's about to drop. There's all these doom and gloom articles. Like, it is weird, the psychology that like impacts you when you get the lump sum. You would think like, of course, I'll just go out and put it all into something, but you do get paralyzed.
Yeah.
Like, where should it go? What should I do with this? So I could see I fall into that. I do have the paralysis on the amount of money that I haven't put in yet. And my some of my siblings also got some of the inheritance, and I've asked them because we've talked about it. Yeah, they came to me like, what should I do with this? What should I put it in? And I told them what I did, and they're still like, I'm still in cash. And this was about 6 months ago now. So you can see they have the paralysis too.
Yeah.
They're unsure, like, even though I said, here's, some good allocations you could do. But it is that's a hard one, I feel. And 100,000, I might be even more paralyzed than 100,000.
And there is no wrong answer here or right answer. Right. I think the key is to at least be conscious of what you're doing. Because here's where what behavioral scientists are looking for is any kind of incongruence, where you say you believe in one thing, but yet you're doing something completely different. So, for instance, let's say that you and I are professional investors. We're also individual investors, and we plan everything out, right? We plan things for our followers. We plan things for our own portfolios. It would be irrational for Tracy to have taken that lump sum and just sat on it and done nothing with it and not applied it to any kind of plan. And I'm not saying she had to take the 100% lump sum and allocate it, but to not do anything with even a portion of it would be like those people, and maybe her siblings, who go, oh, I just got to wait for a better dip because they're so worried about, people are worried about having bad timing, right?
Yes.
They don't, oh my gosh, I'm gonna regret so much if I don't buy the low.
Yeah, the timing and just the number of choices. Because it says in the Schwab talks about how if someone was selling jam, they had some kind of study that showed more people will go to the jam at like a farmer's market thing where they have a lot of choices. So they get more people to go over to their booth because, oh, look, they have 20 jams. But the booth that only sold the 5, because there's only 5 to choose from, they actually sold more. So that makes sense to me, because when you get the lump sum, suddenly the world is your oyster. But what does that mean? You think you would like, oh, of course, I'm just going to put it into these 4 stocks or these ETFs or whatever. But you get overwhelmed that now I have all these choices.
Right. And that's why having a plan is so important. And there's not one plan that fits everybody, but if you learn about how people create a 10-year, 20-year investment/retirement plan, then you see how you can mix and match it for yourself, and you can talk and you can work with an advisor. Advisor does, you don't have to give your money to an advisor and let them make all the decisions. You can just take advice from them. So then if you have a plan, then you're kind of ready to make some decisions, and your plan is based on certain realities. There is a commonly known statistic that the stock market advances 10% every year. On a 100-year view, you can expect to get 10% returns from the stock market. Well, in 5 years, is that going to be true? Are you going to keep compounding 10%? Not necessarily.
Right.
You could have a bear market at any time.
Yeah.
But if it's 20-year money, like you don't need to see it for 20 or 30 years, then you should be investing like that and not worry about the recessions or corrections. Right. Yeah, once in a while you can do some market timing. If the economy goes into recession, sure, you can take some money out and and try and buy the lows. But so your plan is always based on what is reality for investing. How does the U.S. economy grow? How do corporations grow? Are they growing their profits? And then the aspect that I love, that I always talk about, is we have fundamental analysis of companies and stocks. Companies and the economy. Then we have technical analysis, the charts. But what I find more fascinating is what I call behavioral analysis of the large investors. We have a enormous investor class base in the U.S. and around the world that has this wealth that they have to buy stocks with, or that they're going to buy stocks with. So if you're following them in a bull market towards stocks, you'll win in the long term. And I have a resource coming up for you about that. But let's get back to the quiz.
Yeah.
Question number 5. After the recent stock market correction, you review your investment plan. Which is the best course of action? A, maintain your current allocation because your long-term goals remain unchanged. Or B, reduce your exposure to equities in an effort to help insulate your portfolio against future shocks. Tracy, what'd you give us?
I did do A.
Okay.
Stay the course.
What's your rationale there? How do you explain that to the average investor?
Well, because it is what you were just saying about long term. It depends on your amount of time that you have, as you just said. But if this is my long term type of goal, then even a 20% correction, or that would be a bear market even, it's still best to stay the course. And I did learn that during the Great Recession, when it was really hard to stay the course during that market correction. And a lot of people didn't. A lot of people just couldn't take the pain and just sold out and got out of there. But there are people who've never gotten back in.
Oh, yeah. Those
10
are the people,
years later.
Those are people not just suffering from analysis paralysis, but also they didn't get any new education.
Yeah.
They didn't find out, what don't I know about how the stock market and the economy work. This is the people selling at the bottom is one of the worst things you can do.
Yeah.
I remember buying on the way down in 2008 and feeling kind of a pit in my stomach.
Yeah.
Like, I thought I was all smart.
I
thought I was all smart buying the S&P at 1,200.
Yeah.
And then adding a little bit more, and then you're at S&P 800, and you're going. But one thing I knew from having experienced the 2001 recession and big correction was that this is probably going to come back. When you look at the underlying economic base of the U.S. economy and its wealth, I'm like, the banking system has collapsed, but it's not going to destroy the economy. So this will come back, and it's come back before. So I didn't panic and sell at the bottom. I just said, okay, we're going to have to ride this back up and average in.
Yeah, that was basically the op-ed that Warren Buffett put on the New York Times. Remember that? In December of 2008, he wrote that op-ed where he said he was buying America. It's always come back. He talked about the depressions and all this other stuff that's happened, and that if you buy now, you'll be rewarded. And he was encouraging people to try, but that was hard by December 2008. Still had a couple more months to go down, and he admitted that he might have be too early, that it might go down further.
I respect Buffett, and at the time, I kind of considered him like, my wise old crazy grandpa in the corner. Because his long term is different than anybody's,
for
right?
sure. His long term is forever, almost. Yeah.
So, but one economist I was listening to a lot was John Rutledge, who was Reagan's economic advisor in 80-81, and he was focused on what is the wealth base of our economy. So he looked at what is the asset base, and his number was like, it was like over 100 trillion. He's like, this is the wealth that's, in real estate and whatever, that, maybe values have gone down, but there is this economic base that will come back. And
Yeah.
so I was like, yeah, that makes a ton of sense. All right.
Okay.
So,
Number
yeah,
6.
I was with A on that
you
one
were?
too.
Okay.
Yeah.
I thought
Of course, I'm not going to sell it to Lowe's.
No.
All right. Question 6. Your portfolio gains 10% for 2 consecutive years before losing half of those profits in year 3. Okay. So you gain 10% 2 consecutive years, and then you lose half of those profits in year 3. How do you react to the ups and downs? A, you don't fret the loss and remind yourself that your portfolio is still up overall. Or B, you're upset and alter your investments to help minimize future losses. I think this one's pretty obvious, right?
Yeah, I said A, of
Yeah.
course. But I could see, because Schwab talks about how people are impacted more by the negative
Yep.
than they are by the positive. So this is true. Like if you owned, a stock for many years, like an Amazon or one of the FANG ones, you're up pretty big. And then, so why panic if it pulls back, 5 to 10%? But people do.
Yeah. The behavioral bias that they're referencing for question 6 here is loss aversion. It's
Yeah.
like people have more of a negative, visceral, emotional reaction to losses
Yeah.
than they do to gains.
That's right.
And that's been proven from the start. I mean,
Yeah.
that's one of the famous experiments, or many of the experiments that Kahneman and Tversky did in discovering loss aversion, and also Richard Thaler. And I should mention the previous behavioral bias they talked about was recency bias. Like, so if a market just crashed, you're so focused on what just happened, like, oh my gosh, pain,
Yeah.
pain, loss, that you want it to go away.
Right.
And sometimes that means just get me out of the market.
Yeah.
So the pain goes away because you're so focused on what happened recently instead of looking at what happens over the long
The bigger
term.
picture, yeah.
All right, question number 7. Although U.S. technology stocks have helped your portfolio achieve double-digit annual growth, your financial advisor now believes the sector to be overvalued. What do you do? A, you explore other industries with an eye toward diversification. Or B, you downplay your advisor's concerns and redouble your research on technology trends. I'm going to tell you what I did here. I went with B.
Oh.
Yeah, because this is actually my story. Is that, and as we talked about it last time I was on your podcast, is I had to ignore all the analysts trying to call the top of the semiconductor cycle and do my own research.
Yeah.
Now, so in that sense, it's not that I'm unwilling to look at other research or take advice. It's just I know when to do my own homework and incorporate those ideas. In fact, once I form my fundamental analysis opinion, then I go out of my way to look for the contrary opinions and say, okay, where could I be wrong?
Right.
So let me read the guy who's bearish on semiconductors or whatever. All right. So what was
But
your?
most people don't do that.
Right.
I don't think.
Well, I mean, that's, and I consider that our job is like,
Right. For
to
sure.
do our homework as much as possible.
Yeah, but I do think they have what Schwab is calling this example, which is the confirmation bias of like, oh, these technology stocks have all worked for me for the last 8 or 9 years. They're going to continue in the future. So why should I sell those and get into those boring retailers or whatever it is? And no, like I'm a genius. I've picked these. And I do feel like with a lot of the tech names, not necessarily the semis, but with the FANG in particular, all of us feel like we're geniuses with the FANG. Don't you? I mean, I do. And it just keeps going up. And I call them the sure thing stocks because everyone believes this story is going to continue and that growth is going to be there for at least the next couple of years.
Well, all right. So how can I explain this without saying that I think I'm a genius? The thing that kept me in the stocks a lot of the times was all the doubt, right?
Okay.
So
The contrarian
yes.
play.
So when somebody says, "Oh, Facebook is overvalued," or XYZ is overvalued, I'd go, "Let me look at the growth rate." You know, and then I looked at Facebook and I'm like, and this is before all the bad news happened with Facebook, but the stock is still near 52-week highs or all-time highs. I said, I looked at the business. Where is the ad revenue coming from? And then I actually got into this circle where I was meeting business owners who were advertising on Facebook. So I met like 100 small business owners who were advertising on Facebook, and to them it was a gold mine. because they knew how to sell their product, whether it was a T-shirt or some nutritional supplement or a service, and they knew how to find their audience, find their people, and get an ROI, right? They could say, I can spend, I can get $3 in returns for every $1 I spend on my ads on Facebook.
Yeah.
So to me, it was like, yeah, it's not overvalued because it's still growing at 30% or 40%. And as long as I could do that with any given company, and we're going to go over some other examples in software in a minute. But let's get to question 8. Question 8, you see a TV interviewer praising a CEO for several new products her company has developed. Should you buy the stock based on the segment? A, yes, because of potentially market-moving news from a trusted source. B, sorry for laughing. You know where we're going with this one.
Yeah.
B, no, because multiple factors influence a stock's performance. Tracy?
Well, I would have to say B on this one. As I always say in my podcasts, even when I'm giving stock recommendations in the podcast, that everyone should do their own, analysis and look at the fundamentals of on any investment you do. Don't just buy into whatever the talking heads are saying. But that being said, I have gotten some good ideas off of watching people in various interviews and seeing CEOs interviewed.
Yeah, I love to watch analysts because Tracy and I are not professional analysts because that's actually a full-time occupation in itself where you have to study an industry and companies in great detail and be very quantitative to get to know that industry and those companies. And so I drink up what analysts are saying. I want to know. Okay. And then I figure out, well, I think they're overly bullish there. Maybe they're overly bearish. And then obviously CEOs, we want to listen to the CEOs on the conference calls or even when they're on CNBC or Kramer. This bias that the Schwab article is referring to is availability bias, right? You see something, it's like it's just like when one of your relatives brings up something, maybe
Bitcoin.
Yeah, exactly. Hey, I saw
marijuana stocks.
I saw this. What do you think about the pot stocks? And my answer to those things, like I got into Bitcoin a little bit, but the pot stocks, I'm proud to say I know nothing about them, and I'm not putting my money or your money anywhere near them. Go find somebody else who knows, because I just don't have the time. I don't have the time to study every industry, and that's one I'm not studying.
Yeah, I do have a relative who came to me recently and said he saw some ad or something about the pot stocks and wanted to know if he should be getting into them. I'm like, no. What was the ad? He didn't even know, just that they were pot stocks.
Yeah, so that's the availability bias.
Yeah.
And sort of a tie into that, earlier this morning, Tracy was a presenter for us in a team meeting we had. We have these research meetings about twice a month. And she chose the topic of Italy because Italy was in the news yesterday. Today is May 30th. And, the stock market was down a little bit because the whole European debt crisis resurfaces.
Yeah.
And so she wanted to help us explore that. And she printed out this great timeline from the BBC, which is like they did like an 8-year timeline of the unfolding Eurozone crisis. Actually, it was they did this in 2012.
Yeah.
So at the time when the Greek crisis was really hot, and we thought, hey, we're talking Grexit, they're going to leave the European Union, and it's going to destroy the euro.
Yeah, remember that?
And then that's going to cause a global recession. And so we had to revisit this stuff. But at the time, I do something fun with my portfolio commentary every night, and Tracy and I have to write to our followers every night to talk about market events. I made sure that I did not talk about Italy last night.
Oh,
because
I did.
Because I saw it as this is nothing.
Nothing. Okay.
Especially when I looked at the chart of the NASDAQ, I'm like, the NASDAQ was down 0.5%.
Yeah.
This is nothing. This is more about the trade war, and so, but this is a huge thing for the availability bias, where you see something in the news and it's the headlines and you think, oh gosh, what should I do?
Yeah. Oh, for sure. Yeah. I did have to say in my commentary, even though I did bring it up, I did tell people that if you actually look at the returns of the S&P for the main years, which was 2010, 11, and 12, when the Greek crisis was bad, that the stock market did finish in the green all 3 of those years, and 2 out of the 3 were double digits. So it didn't seem to impact as much as you might think back then either.
And we did all that laundry, is what I say about the Greek crisis. Like, we went through that and hand-wringing and whatever for over 2 years, and we saw that, hey, there's not going to be any contagion, because once Mario Draghi spoke these words, that he'll do whatever it takes.
Oh, yeah, that's right.
Then
wasn't that during the Greek thing, right?
Then I knew. I'm like,
whatever it takes.
Super
that's
Mario
right.
has got this covered. They are not going to let the greatest monetary experiment ever fail.
Yeah.
Right? They didn't build the euro on a whim. They need it to succeed. They want it to succeed.
Good point.
And they're going to try regardless of the giant debt.
Yeah.
Okay, so along this theme of, are you being an investor with a plan and then knowing what your time frame is, Tracy and I end up doing a lot of short-term trading too, because part of the Zacks quantitative model is based on earnings estimate revisions that tend to cycle around quarterly earnings reports. Mm-hmm. So the ideal trading window for a lot of the Zacks rank is a 1 to 3 month window. And so we will find ourselves doing shorter term trading. We're not saying to ourselves, oh, we're definitely only going to trade the stock for 1 to 3 months. Sometimes we love it if a stock has earnings momentum and it keeps becoming a Zacks number one rank, and we can just own it for 3, 4, 5, 6 quarters. I just coincidentally today had the great experience of selling a big winner, Align Technology. They make the Invisalign clear dental straighteners. Sold it for a big gain in my healthcare innovators portfolio, but I had also traded it in my Taser short-term trading portfolio. And the first thing Tracy asked me was like, well, where'd you have the bigger gain? I'm like, the long-term portfolio, because that is really an important theme.
Yeah.
Like, if it's so tempting to trade. It's like, what were you telling me? You saw some stats of what the average holding period has declined from 8 years to
under 2. It's like 1.9 months now.
And this is the electronic world we're in. Everybody's got, they've got an online account, and at the click of a mouse, the technology is so fast that you point and click and you buy or sell. And people are making dumber decisions there too. All the bad decisions we just talked about, they are made easier by point and click. And I'm sure Charles Schwab knows this too, and that's why they want to educate their investors. Hey, step away from the mouse and think about that. Do you really want to take the short-term or long-term, short-term loss, long-term gain, whatever, when this could be a big winner? And that's how I looked at Align Technology in a long-term portfolio, my healthcare portfolio. And I looked at it differently in my trading portfolio, where we just took like 57% gains out of it. So,
that's all.
Yeah. But I look back at mistakes that I've made this year. I wrote an article in March, and I titled it "A Wonder to Behold: Last Innings of the Bull Market." And the concept that I'm trying to share and teach here is that a bull market usually ends in some kind of euphoria.
That's
and
right.
We haven't seen that yet.
No.
Valuations are not extreme on the aggregate. The economy is actually accelerating. We're not, we're going from 2.5% growth to possibly 3% growth. Interest rates are still low, even though they're rising. So there's like all these tailwinds for the economy and the stock market, and you're seeing some stocks really take off. In this article from March 15th, "A Wonder to Behold: Last Innings of the Bull Market," I had to highlight, I said, I've been all over technology with the semiconductors, but I haven't been as adept or agile or confident with software. But I did pick what I thought were a couple of great companies last year, and that was Salesforce, CRM, and Adobe. And the reason I picked them is because, like a Facebook or an Amazon or a Google, I saw these as like key franchises that were building, they were embedding themselves in corporations. So once a corporation adopted Salesforce's CRM, then it became their life, right? And I did a video last year about how IBM partnered with Salesforce to make, like, IBM has Watson, Salesforce invented Einstein. So they, adding more AI intelligence, right? And further endearing themselves to their corporate customers. And I'm like, God, I got to own CRM here. So I bought CRM, and the stock just did nothing for like 6 months, made like 5% on it. And I thought, the market's acting funny. I'm going to get out of this. I sell it, and the thing is up 50%, and this is what happens. It's like, the stock actually grew into its valuation.
Right.
So there was a time where people were like, oh, I'm not paying 90 times for that. Well, now it's trading under 60 times, even though the stock went up 50% because the earnings went up too.
Yeah.
Same thing with Adobe. Adobe is just on a tear now. Where's it trading? New all-time highs above 150, or I'm sorry, above 250. That was another one I owned. I owned it at 150 and let go of it like at 160.
Oh no!
Because of the same thing. Like I owned it. It wasn't moving. I thought, what? The market's not going to pay for this valuation. We went into the correction. I'm like, we got to be out of here. And it's just soared since because of the same thing. Adobe just keeps building their platform for corporations. Corporations can do their own in-house marketing, advertising, whatever, using Adobe creative platforms. So those are my two big examples of software companies that I should have stuck with because it's not the end of the bull market.
Right.
And that's why they've taken off. You got any stories like that? Any software in particular, maybe?
No, not really. I have a couple of cloud names though.
Yeah.
And those pulled back for a while there because people were getting a little jittery about that area.
And did you get rid of them or keep them?
No, I kept them, and then I bought in on some of them after the pullback.
Now, was this personally or in
no,
some of your
this is in some of my portfolios.
Oh, okay.
Yeah. But I've seen other ones, but outside of the tech areas that have been, there's been these big pullbacks, but I didn't think it was the end of the story either. Some people panicked on certain areas. I feel like the staffing companies, people panicked on those and sold out of those like it's over. But no, they're reporting some of the best earnings of this cycle.
And here's to me, Salesforce, CRM, and Adobe are the two stocks that I can like really look at myself in the mirror and go, you did not act according to what you believed. You believed a certain thing, and then you went and you did a research process, and then you did a really bad decision process. You did not follow through with your plan, because those are incredible franchises, and two smaller companies that are not incredible at all, but because software is soaring, are Twilio and Zendesk.
Okay,
here are a couple really overvalued, right?
Yeah.
I don't even know if they have turned into profit yet. And I thought about dabbling in them, taking a shot. Now, anybody who took a shot in those stocks at $25 or $30 is very happy. They've nearly doubled their money. But those were two I couldn't say for sure that you should have bought. Another one that I should have bought because I knew better because of the Facebook story was Shopify. Shopify as that shopping platform. So I'm going to post the link to this article in the article that goes with this podcast. Always, I don't know where you listen to the podcast, maybe on iTunes, Spotify, whatever. But if you find the link on the Zach's website, there's always an article with more links and the stock tickers and good stuff like that. Well, Tracy, we have really kicked this topic pretty well today. We haven't covered everything, but I hope it was
fun.
Yeah, and I hope it helps some people. Like, examine your biases,
right?
Make a plan.
We all have the biases.
Yeah, exactly. They're in there. There's you have this your brain. You think you're one person, but there's things going on behind. Yeah. So, all right. Thanks for joining me, Tracy, and look forward to hitting you up on Market Edge podcast soon.
Definitely.
All right. Thanks for joining us, people.